The reason 95% of traders fail is not due to a lack of strategy. It is due to a misplaced dollar sign. As long as you see a loss as $5,000 gone, a direct subtraction from your life, your rent, or your ego, you are not speculating. You are gambling with sentiment. The market does not care about your needs. It does not care about your hopes. It only cares about the mathematics of supply and demand. Until you divorce your capital from your identity, you will never see the market clearly. You will never be able to execute true speculation. You will remain a victim of the tape, driven by panic and hope. Remove the dollar sign from the risk. See the data. Master the math. Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message, and you let me know this work is not in vain. The market is a giant probability engine. It is a complex calculation unfolding in real time before your eyes. It is not a moral judge. It is not a reward dispenser. It is certainly not a charity established for the benefit of the unprepared. Speculation is the art of assigning probabilities to future movements based on past behavior and current conditions. That is the whole of the pursuit. It is calculation. It is not prophecy. Every position opened, no matter how certain it feels, is merely a hypothesis put under test. You are testing your judgment against the arithmetic of the crowd. The outcome, win or lose, is secondary to the soundness of the initial hypothesis. The financial outcome is merely the result of that test. If you treat the opening of a position as the starting gun of a moral contest, a challenge to your personal genius, you are lost before the first swing. You must accept this mechanistic definition of the market. It operates under laws as rigid as physics. The emotional trap begins when we treat trading capital as personal savings. This is the great error. It is the primary cause of ruin for the inexperienced man. Once funds are allocated to speculation, they cease to be money for bills or money for the family. They become units of risk exposure. They are dedicated capital. They are a professional budget. To attach personal, heartfelt value to these units is to guarantee irrational decision-making when the units decrease. The moment the loss triggers the thought, "That is my children's education shrinking," you are ruined. You have confused the professional balance sheet with the domestic ledger. The speculator must draw an iron curtain between the two. The money dedicated to the market must be seen as inventory. It is the tool of the trade. Would a merchant panic because his stored goods depreciated slightly before he sold them? He would note the change in value, adjust his strategy, and proceed. He would not weep over the stored barrels. The capital must be handled with the same clinical objectivity. It is stock. It is inventory. It is the necessary fuel for the engine of speculation. A loss is not a failure. It is data. I repeat this until the meaning sinks deep into the bone. A loss is data. It confirms that the underlying hypothesis for that specific trade, the timing, the entry point, the choice of instrument, was incorrect at that moment. That is all it means. The P and L swing must be logged only as a coordinate on a graph. It informs the system. It must never feed the ego. And if you are a professional, you are searching for confirmation that you are right. When the market moves against you, it is confirming that you are wrong. It is a fact. How can a rational man become angry at a fact? How can a mathematician become enraged because his equation did not balance? He simply checks his calculation, finds the error, corrects it, and proceeds. The anger, the frustration, the pain, these are triggered only because you saw the movement as a personal slight or as a loss of your hard-earned dollars. And the moment you see the loss amount as nothing more than a confirmed negative data point, the emotional weight vanishes. You become free to observe the tape objectively. The information gathered from a loss, the reason the trade failed, is often more valuable than the profit gained from an easy win. You paid for that information. Now use it. A disciplined stop-loss is not an admission of defeat. It is the necessary and budgeted cost of gathering market information. Every professional system in the world operates with a research and development budget. You must spend capital to find out where the true opportunity lies. In speculation, the small controlled loss is your R&D cost. You pay to find out if the major move you anticipate is coming. If it does not come, or if the market tells you the timing is wrong, you exit. You have paid the toll. The toll must be small enough to be inconsequential to the overall health of your capital. The amateur refuses to pay this toll. He refuses to take the small budgeted loss because he is stubborn. He knows he is right. He holds on, turning the budgeted R&D cost into a catastrophic principal loss. This is the difference between the mechanic and the gambler. The mechanic knows he must replace a worn part. It costs money. It is necessary maintenance. The gambler believes the worn part will magically repair itself if he simply ignores the danger. The market demands maintenance. The small quick stop is the maintenance fee for your speculation machine. Pay it cheerfully. It protects the whole apparatus. Risk is measurable, definable, and budgeted. Ruin is the emotional response to an unplanned loss, leading to catastrophic action. I learned early that if you treat risk mathematically, as a fixed percentage of total capital per trade, you remove the possibility of emotional ruin. Ruin occurs when the loss is so large that it paralyzes the speculator. It creates despair. Despair leads to reckless action, hoping to claw back the loss in one desperate throw. If your rule is rigid, if you never allow a single trade to risk more than 1%, perhaps 2% of your total stake, then even a string of 5 losing trades is merely a setback. It is 5 data points in sequence. It is not threatening. The loss feels negligible, and thus your decision-making faculty remains entirely intact. The mathematics insulate the mind. If you disregard the percentages, however, and allow a loss to shave 10 or 20% off your capital, the emotional damage is immediate. You cease to be a calculator. You become an injured animal lashing out. That is the pathway to ruin. Mathematical discipline is the only true firewall against the market's emotional destruction. Measure the risk, budget the damage, then it is merely a calculation. Do not evaluate the success of your method based on a single trade. Evaluate it over a series of 10, 20, or 100 transactions. This is the statistical perspective required for solvency. A losing trade is only one data point in a distribution curve. If your proven edge shows that you profit on 60% of your trades, then 40% of those trades must necessarily be losses. A loss is therefore not a flaw in the system. It is a necessary function of the system. If the market is a river, the disciplined speculator is fishing with a strong net. He knows he will catch driftwood and weeds, the losses, but over time the volume of fish, the profits, will make the endeavor worthwhile. The amateur, however, lets the pain of the current loss override the statistical certainty of his proven edge. He catches one weed, throws his net away, and declares fishing impossible. You must detach from the single outcome. You must zoom out. If you take a series of 10 trades and 8 of them are stopped out for small budgeted losses, do not despair. The discipline of the system held. The system prevented disaster. Now, if the next 2 trades are correct, and they yield profits that eclipse the first 8 losses combined, that is successful speculation. The system is defined by its outcome over time, not by the anguish of any single isolated result. Trust the arithmetic of the series. The most toxic emotional reaction is the need to recover the preceding loss immediately. This is the guaranteed path to the poorhouse. This need to recover transforms a disciplined pursuit of edge into an emotional quest to erase a data point. You are trying to retroactively change history. The market does not care that you lost money 10 minutes ago. It has already moved on. When you enter a recovery trade, you are no longer asking, does the evidence support this position? You are asking, is this position large enough and risky enough to make me feel whole again? This shift from math to ego guarantees oversized, ill-timed, and desperate entries. The criteria for entry is no longer alignment with the market's trend, but desperation for capital replacement. The moment you feel the urge for recovery, you must step away from the tape. Take a walk, reread your rules. Remind yourself that the lost capital is simply gone. It is a sunk cost. It is a piece of information received. Your only objective now is to find the next clean, high-probability setup, based purely on technical evidence, entirely divorced from the previous transaction. You cannot force the market to give back what it took. You can only patiently wait for the next opportunity that it provides. Mathematical discipline through position sizing is the ultimate safeguard. It is emotional insulation. If a loss only costs you 1% of your total capital, the pain threshold is managed. The outcome is manageable data. You feel the sting, but you are not wounded. You remain operational. If a loss costs you 20%, it is an absolute catastrophe. It invites panicked behavior, immediate over-leveraging, or total paralysis. The size of the position must be dictated by the size of the total capital and the distance to the stop loss. This is the math. If you are compelled to take a larger position than your rules allow, if you feel you must make a killing, you have moved beyond calculation and into yearning. This is why small accounts are often so difficult to manage successfully. The margin for error is too thin. The temptation to leverage beyond safety, simply to achieve a meaningful return, is too great. The professional operates within rigid, fixed boundaries. They control the sizing to ensure that even the maximum expected loss will never compromise their ability to continue operating. Sizing controls the emotional damage of the math. Control your size, and you control your fear. A market operator must see themselves as the objective mechanic of the system. You are the technician. You are the engineer. The system runs the trades based on established signals and conditions. Your job is to ensure the inputs, the sizing, the timing, the placement of the stops, are accurate, precise, and executed without hesitation. The mechanic does not feel pain when a machine part fails. He does not curse the broken cog. He simply observes the failure, understands why it failed, the data, replaces the part swiftly, and continues operating the machine. You must adopt this mechanistic mindset. Your personal feelings, your hope for a quick profit, your disappointment over a stopped-out position are irrelevant to the operation of the system. They are noise. The greatest profits are only achievable through relentless, emotionless adherence to the plan. If the tape tells you to exit, you exit. The reason you exit is because the calculation has changed. It is a logistical move. It is not an emotional surrender. Your strength lies not in your cleverness, but in your ability to be objective, disciplined, and tireless, like a perfectly maintained machine. The fear of loss is insidious. It often prevents traders from scaling into winning positions. You hold back because you are terrified that the profit you have already accrued might vanish. You fear the inverted outcome. The mathematical acceptance of a defined small loss frees the trader to truly capitalize on the massive profits that arise from correct speculation. You must accept the small downside, the data, to achieve the massive upside, the true return. If you are right on a major move, the market will tell you so by continuing to move in your favor. But you must be there to take advantage of it. If you are timid, if you fear that the market will reverse and snatch back the initial small profit, you will liquidate too early. You trade out of fear of the negative data point. You miss the bulk of the money. It is only when the loss has been psychologically accepted as a minimal cost of doing business that the speculator gains the nerve to sit tight, to wait for the profits to run, to pyramid a position as the market confirms its direction. You pay for the downside certainty with your budgeted stop. Once that payment is made, you must claim the full measure of the upside uncertainty. Do not truncate the profit just to avoid a minimal price reversal. The truly successful speculator views capital risk as a form of currency. He spends a small amount of lost currency to purchase a large amount of profit potential. It is an investment in probability. It is math, pure and simple. The market does not recognize your tears. It does not recognize your fear. It certainly does not recognize your hope. It only recognizes the cold, hard mathematics of the movement of capital. Your objective is not to win every transaction. That is vanity. Your objective is to maximize your edge over a long series of transactions, ensuring that your winning transactions are far larger than your necessary and budgeted losing transactions. Today, commit to this truth. A loss is simply information. It is a necessary cost of maintaining a solvent and profitable system. Remove the dollar sign from your fear. Do not let the price change dictate your emotional state. See the data. Master the math. And the market will eventually yield its fortune. The statistical mindset that allowed Jesse Livermore to eventually detach from his losses and treat them merely as cold data points was not developed cheaply. He paid steep market penalties, the high cost of an unavoidable apprenticeship, to internalize that wisdom. This enduring education was meticulously documented by Edwin Lefebvre in his 1923 classic, Reminiscences of a Stock Operator, granting the reader access to the entire career of the famed Larry Livingston. Reading this work is the most efficient way to undergo the rigorous training required for success, effectively conducting one's development within a textual proving ground before confronting the actual arena. Since the intricacies of 1920s tape reading require careful interpretation for the modern operator, we highly recommend the definitive annotated edition by Max Davidson, which provides the precise commentary necessary to translate Livermore's 1923 methodology into a usable blueprint for the current environment. A link to this essential edition is provided in the description below. You can watch hundreds of hours of content and read dozens of books about the market. You're filling yourself with knowledge, which is excellent. But knowledge alone won't make everyone rich, because not everyone possesses the right foundation. The market is the same for everyone. The only difference lies in the mindset. You can have a perfect trading system, but if you lack discipline and an understanding of your own psychology, that system is worth nothing. I often see a recurring theme in your comments. It is easy to talk about strategy in theory, but when it comes to the actual trade, many struggle with emotions. For those who want to focus on discipline, patience, and self-discovery within trading, I've created a new channel called the Stoic Trader. I believe it will help many of you bridge these gaps. So if you think this kind of content would be useful to you, go ahead and check it out. The link is, as always, in the description below.